Hello, this chart profit video. We're approaching 3 hours into the trading day, Friday 23rd of February. This from the pre-open today. We're looking at the E-mini S&P. The important level currently, the closest important level is this one here, 26.86. That's the 3-month controlling price. Good news so far since the market rallied back from the decline the other week is that the most recent 5 value areas here have been printed above that controlling price, and that's usually a supportive, positive sign. Overnight on Wednesday we actually just saw a very brief test of that level, but it's held. The other positive sign in the short term are these 2 markings here, which are aggressive buying on those 2 days. And so far we haven't seen much of a response from the sellers. We've basically held these higher levels, higher relative to the past few days, and the sellers haven't stepped back in yet. So I'm thinking the first sign of trouble in the short term would be a value area printed below that level, below 26.86. That would probably indicate a retest of the 6 month down here at 25.81. If we see a value area printed below that level at any point, that would be an indicator of longer term weakness. So I'm showing those levels here on a current hourly chart. This one here, 25.86, is the 3 month, and you can see that overnight test at that point, and we've held. And the lower controlling price, the 6 month here, 25.81, and you can see the brief, well, a few hours printed below that level at these 2 points, but all value areas holding above that level. So the critical thing in the longer time frame, a value area or price acceptance below that level, I think would indicate lower, and that would be a major sign of weakness on the longer time frame. But currently we've recovered and we're holding up pretty well, and in fact holding that less important 3 month there at 26.86. If I just add in here the halfway point off the high, that is the low of today's session. Just looking at the pulse chart here, I've translated those green and red imbalances from the futures onto the spider chart here. So you can see those 2 aggressive buying days here and the aggressive selling that kicked off the recent correction. I made a point recently of pointing out that each of these aggressive buying days we were marking the lows on these days, and they weren't really tested until we got to this point. And right in here I said that the uptrend was slowing because of that. We actually broke below the low of an aggressive buying day, and then we saw the aggressive selling coming down here, and at this point over here we printed back above the high of that aggressive selling day, which indicated a slowing or a possible reversal of this down move here. So currently we have 2 aggressive buying days, which on the short term time frame is encouraging. We still need to see the breadth indicator in the middle here improve. That needs to return to green and may take a while, but confirmation of any kind of uptrend, if we see the market picking up, you want to see the price momentum back above 0, at which point it turns green. So the pulse chart actually in the longer term down here doesn't look good. I've discussed this before, but in an environment where we're green on the breadth and the price momentum, you'll find the aggressive buying on the day frame is usually pretty effective. And right now with the red here, if we saw a red bar coming in, aggressive selling, we'd probably see the market lower. Here's the spider holding above the 4 month here at 267.18. And if we look at the halfway point off the high, which is this dotted line here, spider is consolidating above that halfway point, which is normally a pretty positive pattern. Price back below 267.18 would indicate a retest. IWM, the Russell 2000 ETF, again above its closest important level at 149.63, the 8-month, and again above this dotted halfway, appears to be consolidating a little pattern above that point. As we discussed last week, the European market's not so strong. This is the Footsie 100 UK index. As relative to the US markets, has retraced very little, and it's below this important level here at 74.13, a much weaker chart. German Dax Index, similar, relatively little bounce here, and below this important level, which is much higher. Let's look at the sentiment indicators. This is my version of the RIDEX assets ratio. Peaked up here above 23 as the market hit its high. The ratio fell pretty rapidly as the market came off, and as the market recovered it continued to fall. Just over the last few days we've seen it rally back. It's currently above 19, which is still, relative to long-term history, a really high number. This from last week's ebook. This is the S&P 500 regular contract commitments of traders data. I'm looking here at the commercials net number, which is this black line here, and that has actually moved to its highest level since early 2016, which is interesting. Indicates the commercials of the smart money were buying the dip. And if we're looking here at the exposure index, which measures equity exposure of active money managers, current equity exposure managed as a percentage here, this being 100%, anything above that level being leveraged. We hit the lowest number this week since November 2016. There's a typo in here, it's 62.69. The index reached an extreme number up here as just before the market peaked. It was 10 weeks ago. Just interesting, I've marked these dotted vertical lines here indicating where the exposure index on this weekly chart falls below its lower Bollinger Band. These tend to mark lows after a sell-off, and at least usually indicate that the market will be higher 6 weeks later. And we've just seen that happen again here. Just to remind you, we are coming lower, these indicators are coming lower from extreme readings 6 or 7 weeks ago. 7 weeks ago, the public poll from AAII, the Bulls percentage reached 59.8%, which was a 7-year high. And in the Investors Intelligence poll, the Bulls percentage 5 weeks ago reached 66.7%. That was a 30+ year high. Bears percentage just 3 weeks ago was the lowest I have in the database. Another crazy extreme reading was in the Lipper US fund flows. Just 4 weeks ago, the 4-week flow number reached 60.7 billion up here. I have no other 4-week flow number close to that, but that has fallen pretty rapidly. 2 weeks ago we had an outflow of 23.9 billion. That was the largest single week net outflow that I have in the database, and the 4-week flow number has fallen to a negative 11.2 billion. That's the first negative number for the 4-week flow in 7 weeks. So these sentiment indicators, at least here, kind of resetting themselves a little bit. As I said, 4, 5, 6 weeks ago, the sentiment was getting truly extreme, and this sort of 10% correction may have set or reset the numbers a little bit and let some of the pressure out. This is TLT, the T-bond ETF. The major level on this chart is at 119. We don't really need to say any more than the chart currently consolidating below that really important level puts it in a really weak position. Fell sharply on Wednesday here, which retested this February, actually March low from last year, and we're not seeing a really sharp decline following that break below that major. If the chart could recover back above 119, it'd put it back in a strong position, and that could get interesting, but currently a danger zone, I think. GLD, the gold ETF, just at the end of this week printing below its 2 months at 126.60. Been oscillating around that level for a few weeks. after its strong rally a couple of months ago. What would be good would to see an oscillator low or a higher low on the chart above that level. That would be bullish. Unless the major, which is at 120.90, migrates, all this price action above that point in the longer term makes this a strong chart. USO, the oil fund ETF, also in a strong position in the longer term above 1141, which is its major. It migrated back to that level in here somewhere. Strong rally, built a 3-month in this little consolidation, and just reaching that resistance today. Price above that point and some consolidation and time above 1278 would put this chart in a strong position again in the short term. Been saying for a while that this target down here, 87.25, which is a major half range, I thought we'd see that tested at some point. I still do, and the dollar index would need to rally unless the 8-month migrates lower. That would take some time, but unless the dollar index does test and reject that half range, which would be an interesting development, I'd need it to minimum get back above 93.46 before looking at the long side. Talked at length about the importance of the dollar yen chart and the weakness. We had this little consolidation pattern here below the 2-year. This was all weak below the major, and again, I couldn't anticipate strength in this chart, at least until we saw consolidation back above the 2-year, or at a minimum recovering back above the halfway point off this low to this high, which comes in about 109, and also previous support. This position here looks a really weak location to me, so not so good for the dollar. Here's the Euro FX chart, strong position. The 2-month at 122.64 has been tested a couple of times, and that's held. Until that breaks down, I'll assume strength. If we see price consolidating below that point, you'd think a retest of the 1-year down here would be in the offing, but currently this looks strong, as does the British pound chart. It's built out a 2-month here at 139.55. Any kind of indication of strength above there, and we probably see a new high. Zooming out on the weekly chart back to the high over here in 2014, we recently pointed out this is probably why the pound has stopped where it has. That's a relatively major halfway point. So here's that halfway point on the daily. What that means is that there's major resistance here at this old high. So if we see price above that and consolidating, puts the pound in a really strong position. Okay, that concludes. Once again, I thank you for watching.